Thank you. I think that's the first time I've walked out to Metallica. So I appreciate the walk-up music. Whoever picked that, that's great. Takes me back to my high school days. So good morning. It's bright and early. Thank you for inviting me to this year's Just Economy Conference. I'm really honored to be here to join you guys today to discuss what we are doing at the OCC to elevate fairness in banking. First, though, I want and I need to say a few words about recent events. The OCC's focus is and continues to be the safety, soundness, and fairness of the federal banking system. We are closely monitoring the market and conditions of the institutions we supervise. The banking system is sound and resilient. Your money is safe. Banks have strong capital and liquidity, and the US government has the tools and the will to act to protect the system. Given the events of the past several weeks, some might think it's odd that as a bank regulator, I want to focus my remarks today on fairness. I do this with intention, because it is precisely during times like these, when the world is fixated on financial and systemic risks, that issues of fairness can get pushed to the bottom of the pile and ignored. We saw this in response to the 2008 financial crisis. The deprioritization of non-financial risks, such as consumer protection, compliance, and operational risk, delayed and may have worsened eventual reckonings, which took place years later with great force and attention. Those reckonings eroded trust in the banking system, much as the financial risks did earlier that year. We can learn from history and do better. We need to be able to walk and chew gum at the same time. Maintain a laser focus on effective financial risk management and work to ensure fairness. Today, I will share what we at the OCC are doing to meet our mission of not just ensuring a financially safe and sound federal banking system, but also ensuring that federally chartered banks provide fair access to financial services, treat customers fairly, and comply with laws and regulations. Since becoming acting comptroller in May of 2021, I've emphasized that persistent inequality can erode trust in banking because people who feel stuck or lack access to responsible, affordable financial products and services may conclude that the banking system is working against them rather than for them. This can compel consumers to turn to non-banks, such as payday lenders, crypto platforms, and fintechs, which often have less stringent safety and soundness requirements and consumer protection oversight than banks. Fairness is a core part of the OCC's mission and something I think about every day. To some outsiders, it may seem like fairness sits in the shadow of financial safety and soundness, stepping out into the spotlight only during enforcement actions, after high-profile scandals, and when certain regulations are being adopted. But insiders know better. In 2016, then Comptroller Tom Curry established the Compliance and Community Affairs Department, which built institutional muscle at the OCC to engage on fairness and compliance issues on equal terms to financial safety and soundness. The legacy of that decision continues to be felt today within OCC leadership. Tom Curry selected Gravetta Gardenier to head the department, which includes compliance policy and compliance supervision functions. Gravetta today now serves as a senior deputy comptroller for bank supervision policy, which integrates fairness, compliance, and safety and soundness policy. In addition, Beverly Cole, who then served as the deputy comptroller for compliance supervision, is now the senior deputy comptroller for mid-sized and community bank supervision, which oversees nearly 1,000 banks. Today, both Beverly and Gravetta serve as members of the OCC's executive committee, which leads the agency. Fairness at the OCC is about more than just people and leaders. Every 5 years, the OCC adopts and publishes an agency-wide strategic plan. The most recent strategic plan leans in on how financial services is evolving and prioritizes elevating fairness, noting as a goal that, quote, the OCC's renewed focus on fairness reinvigorates the agency's mission and demonstrates leadership as the evolution of the banking system further integrates fairness with safety and soundness. Of course, actions matter most. Our people and our words must drive meaningful actions for us to have credibility and to be trusted on issues of fairness. With this in mind, I'd like to share some examples that demonstrate the OCC's commitment to action in elevating and advancing fairness, especially for the financially vulnerable. Let me start with overdrafts. For the increasing number of people who feel like they're living paycheck to paycheck, the maxim, it's expensive to be poor, resonates. Overdraft fees can be one of those expenses. Excuse me. At last year's ABA annual meeting, I noted that I was seeing a wide range of banks beginning to re-examine their overdraft practices, and that a significant number were contemplating or implementing meaningful pro-consumer reforms. My message to bankers was clear. Quote, you don't want to be the last bank to update your overdraft program. This message was one that I repeated in other public settings, as well as in private conversations with bankers. OCC examiners echoed that message and encouraged bank management to review their existing overdraft programs to consider pro-consumer reforms they might want to consider. Every bank is different, and OCC examiners are uniquely positioned to combine in-depth bank-specific knowledge with a broader national perspective on leading and lagging practices. Overdrafts can present a variety of risks, including compliance, operational, and reputational risks. An important risk is the risk of engaging in unfair or deceptive acts and practices, commonly known as UDAP, which is prohibited by Section 5 of the FTC Act. Under that law, a practice may be deceptive if there is a representation, omission, act, or practice that is likely to mislead. It is deceptive from the perspective of a reasonable consumer in its material. Practice may be unfair if it causes substantial consumer injury that is not outweighed by benefits to the consumer or competition, and importantly, the injury cannot be reasonably avoided. More than a decade ago, the Dodd-Frank Act added new authority that reinforces these legal requirements while also adding a prohibition on abusive acts or practices. Last year, the CFPB, which has rulemaking authority over UDAP, cited unfair, deceptive, and abusive practices associated with so-called surprise overdraft fees. In addition, the Federal Reserve and the FDIC have noted the risk of violating UDAP in connection with certain overdraft practices. Importantly, not all overdraft practices are equally risky, so some precision here is warranted. From a bank regulator's perspective, we've identified two practices in particular that present heightened risk: authorized positive settle negative, APSN, and representment. The phrase authorized positive settle negative refers to the practice of assessing overdraft fees on debit card transactions that are authorized when a consumer's available balance is positive, but later post to the account when the available balance is negative. So this happens, for example, when a customer swipes their debit card after checking their balance on their banking app, which indicates that they have enough money for the transaction. However, when the bank deducts the amount of that transaction from the customer's balance, the bank does not actually reserve the funds to use for settlement. So subsequently, different transactions in the customer's account may be authorized or may settle. So when the initial debit card transaction finally settles, there are no longer sufficient funds, and the bank assesses an overdraft fee. With APSN transactions, consumers believe they have enough money in their account to pay for something, only to find out later that they don't, and then are charged a fee, hence the surprise. The compliance risk with APSN transactions is elevated, especially as it relates to UDAP. For example, even when disclosures accurately describe the circumstances under which consumers may incur such fees, the fees may be unfair if consumers are unable to reasonably avoid injury, and the facts support other factors to establish unfairness. Many banks have already eliminated APSN-related overdraft fees and are in the process of doing so. However, some community banks have noted that a third-party service provider that does their core processing has not offered a technical solution to avoid the APSN transactions. When possible, I encourage those core processors to address their client bank requests for technical adjustments to eliminate APSN-related overdraft fees. Representment fees are distinct from APSN, but also pose significant UDAP risks. When a bank receives a check or ACH transaction that is presented for payment from a customer's deposit account, and the account has insufficient funds to cover the transaction, the bank may decline to pay and then will charge the customer an NSF fee. Banks may also assess an additional fee each time a third party, usually a merchant, resubmits the same transaction for payment, thus resulting in multiple fees for the same transaction. Through ongoing supervision, the OCC has found representment fee practices that pose UDAP risk. For example, disclosures may be deceptive if they do not clearly explain that multiple or additional fees may result from multiple representments of the same transaction. Even when customer disclosures explain that a single check or ACH transaction may result in more than one fee, a bank's practice of assessing fees on each representment may also be unfair if consumers cannot reasonably avoid the harm and the other factors for establishing unfairness are met. Consumers typically have no control over when a returned ACH transaction or check will be presented again and lack knowledge as to whether an intervening deposit will be sufficient to cover the transaction-related fees, which may result in substantial harm. No limits. So in addition, bank overdraft programs that have no limits on the cumulative fees that may be assessed can lure some customers into high-cost debt traps and thus heighten compliance and reputational risks. A high limit, or the lack of a limit, on the number of overdraft and NSF fees that can be charged in a single day has contributed to determinations that banks' overdraft protection programs as a whole were unfair. Lower fee amounts or limits on the number of fees that can be accumulated over a period of time can reduce or even effectively mitigate this risk. Stepping back, the good news is that in 2022, we saw OCC-supervised banks of all sizes adopt pro-consumer reforms that decreased their reliance on overdraft fees. The CFPB found that overdraft fees overall were 33% lower in the first 3 quarters of 2022 than in the same period in 2019, pre-pandemic. It also reported that overdraft fees have trended downward in each quarter since the fourth quarter of 2021. I want to be clear. Most of the bankers I have spoken with have embraced this conversation on overdrafts and reform possibilities. They understand the importance of treating their customers fairly and have been open to learning about best practices. These bankers are committed to being there for their customers and providing them with short-term, small-dollar liquidity when it is needed most. Many customers tell their banks, as well as other groups, that this banking service helps them to meet payments when they come due. What we're all trying to do here is to improve the fairness of these programs by making them more pro-consumer, not to eliminate them. More fairness means more financially healthy communities, which means more trust in banking. Let me turn to discrimination and bias. To treat customers fairly, bank products, services, and practices must be free of discrimination and bias. Here I'd like to highlight 3 areas of focus at the OCC: lending, appraisals, and artificial intelligence. So discriminatory lending practices are illegal, exacerbate inequality, and erode trust in banking. To help combat these illegal practices, the OCC is taking steps to strengthen our supervisory processes and resources devoted to compliance with fair lending laws. In January, we published a comprehensive update to our fair lending booklet, which is part of the Comptroller's handbook. This booklet, which had last been revised in 2010, now guides our fair lending examinations. The updated version provides transparency into how we approach fair lending exams, including new details on exam scenarios. It also includes clarified and expanded risk factors, new explanations of risk management and third-party controls, and additional details about applicable legal standards. We've also updated our annual process for screening mortgage lending activities to leverage the new HMDA data fields, and to enhance the redlining screens by incorporating updated peer analysis and evaluation of assessment areas. So these updates together strengthen how we risk focus our fair lending examinations, support more effective fair lending exam strategies, and allow us to better deploy resources and identify weaknesses or potential discriminatory practices. With regards to appraisal bias, bias in the appraisal of home values exacerbates and perpetuates inequality. It's noted in the recent PAVE report, perhaps the biggest drivers of the racial and ethnic wealth gap today are the racial and ethnic disparities in rates of home ownership and the financial returns associated with owning a home. The OCC is taking an active role in the PAVE task force to evaluate the causes, extent, and consequences of appraisal bias. We're also developing and enhancing our supervisory methods for identifying discrimination in appraisals, taking steps to ensure that consumers know of their rights regarding appraisals, and supporting research that may lead to new ways to address the undervaluation of housing in communities of color. AI. Finally, let me say a few words about AI in the context of discrimination and bias. In 2021, the OCC joined with other federal banking agencies in issuing a request for information on the use of AI and machine learning. The core concerns remain salient today: the unexplainability of model outputs, the limits of training data, and risks from updates involving little to no human interaction. Unless we proceed carefully, AI adoption may inadvertently reinforce or exacerbate old biases and discriminatory practices from the past and prevent growth and progress toward a fairer system. Fortunately, there's a keen awareness of the so-called alignment problem among AI researchers. How can we ensure that AI models do what we want them to do? Bankers have generally taken a prudent approach to AI adoption, and some community organizations have begun to survey best practices related to AI controls and risk management. However, my sense today is that we are all soon going to be struggling to keep up with the accelerating speed of AI development. Institutions may soon face strong pressure to rapidly adopt and deploy AI technologies to avoid being left behind. The recent release of ChatGPT and Microsoft's integration of it into its products has accelerated the race to make AI accessible and deployable across a wide range of domains and risks. Although several large banks announced limits on employee use of such technologies, the promise of greater efficiency through chatbots and co-pilots for compliance and underwriting will make it difficult for bank management teams and boards of directors to ignore. When that happens, will the controls be in place for banks and regulators to be able to detect when an algorithm may be reinforcing or introducing discrimination and bias? In 2015, Google released automated captioning in its Google Photos app. Some of you guys may remember this. Unbeknownst to its engineers, it ended up labeling pictures of certain individuals in highly inappropriate and racist ways. Once notified, Google quickly shut it down. The post-mortem revealed that the problem was not the algorithm per se, but the training data that reflected an internet's worth of discrimination and unconscious bias. Imagine making a mistake of this type when deciding whether to underwrite a small business loan, or pricing a mortgage, or offering a credit card. Getting governance and controls right ex ante is, I believe, critical to building the public's trust in how the banking system uses AI. Done right, the benefits are potentially enormous. As I've noted in other contexts, the better a car's brakes, the faster one can safely drive it. Developing good controls for AI, especially regarding discrimination and bias, should be in the shared long-term interests of banks and consumers. Let me turn now to expanding inclusion and opportunity. Ensuring that federally chartered banks provide fair access to federal services, financial services, is the second fairness prong of the OCC's mission statement. Our country's history of slavery and segregation, of bouts of jingoism, and of state-sponsored redlining serve as an important backdrop to this. Expanding financial inclusion and opportunity are not just feel-good buzzwords. They are imperatives. A banking system that is financially safe and sound, but not fair and inclusive, is a system at odds with trust, growth, and democracy. The OCC's focus on expanding inclusion and opportunity are currently centered on strengthening and modernizing the CRA and maturing Project REACH. So you guys, this audience is well aware of our efforts to work with the Federal Reserve and the FDIC on strengthening the CRA. The CRA is the key tool in the bank regulatory toolkit to expand financial inclusion and opportunity for all Americans, especially the underserved. I don't need to belabor the point here. I'll simply note that we're working hard to incorporate and respond to feedback provided via comment letters to our NPR. Regarding Project REACH, It's rapidly approaching its third year anniversary. Project REACH was initiated in 2020 following the murder of George Floyd. By serving as a convener of leaders across banking, civil rights, technology, and community organizations like NCRC, the OCC is helping to catalyze solutions to eliminating barriers to financial inclusion. REACH has notched a number of important successes, facilitating pilot programs to make those without credit scores visible to lenders, securing pledges from 24 banks to revitalize and support MDIs, promoting home ownership for the underserved and those on tribal lands, and supporting minority small businesses' awareness of special purpose credit programs. And this is just a partial list, of course. The challenge for us going forward is building on REACH's momentum and institutionalizing it, building it into our DNA and processes while maintaining the magic of bringing highly motivated individuals together to collaboratively and creatively break down key barriers to inclusion. As one of REACH's founding members, NCRC has played an important role in guiding and supporting us to do more and to stay focused on outcomes. I look forward to continuing this work as REACH enters its fourth year. Finally, I want to highlight the importance of making banking accessible to all who want it. Approximately 6 million US households are unbanked and lack a bank account. A much higher number, nearly 19 million households, have a bank account but rely on non-bank products and services, such as money orders and check cashers, pawn shops, auto title lenders, to meet some of their banking needs, and thus are deemed underbanked. Behind these statistics are people, immigrants, students, laborers, parents between jobs, citizens who live in banking deserts. Fully including them in the banking system can help unlock their potential and help their communities grow. Campaigns such as Bank On and similar bank-specific efforts to provide low or no-cost bank accounts can make a big difference in this regard. So in conclusion, thanks for bearing with me this early in the morning. Fairness in banking matters as much as financial safety and soundness. This concept is inscribed in the OCC's mission statement, which calls on the OCC to, quote, ensure that national banks and federal savings associations operate in a safe and sound manner, treat customers fairly, provide fair access to financial services, and comply with applicable laws and regulations. We are elevating fairness in our strategic plan with our people and processes and through our actions, some of which I've highlighted today. As a financial regulatory agency, the OCC has an extraordinarily strong culture, the strongest of any of the agencies I've been at. This is due to our people and our history. The OCC's founding dates to the Civil War, when the Union needed a national banking system to fund the war effort and bring the country together. Lincoln saw the abolition of slavery as not just a moral imperative, but also an economic one. In the July 4th address to Congress in 1861, he argued, quote, "This is essentially a people's contest. On the side of the Union, it is a struggle for maintaining in the world that form and substance of government whose leading project is to elevate the condition of men, to lift artificial weights from all shoulders, to clear the paths of laudable pursuit for all, to afford all an unfettered start and a fair chance in the race of life." 2 years later, Lincoln would sign what's known today as the National Banking Act, creating the federal banking system and the Office of the Comptroller of the Currency to oversee it. We carry this history proudly today. Thank you.
Can everyone hear me?
It's Jesse.
Yeah, it's Jesse. Good morning. You all know me. Well, I just wanted to start by saying, because I didn't get to give you a proper introduction, Mike Sue is probably the most intellectually curious, open, accessible comptroller, maybe even bank regulator, period, that I've ever worked with, and we thank you for that. Mike. So obviously, the topic that I think is top of a lot of people's mind is the collapse of Silicon Valley Bank, Signature Bank, of course, Silvergate Bank, which sort of evades notice in some ways. And this is something, Mike, that really you talked about. You gave a speech before the collapse about sort of too big to manage. And in that speech, there was kind of a footnote, and that can happen at almost any size. I'm paraphrasing, but so in a sense, you saw this coming, not perhaps the particular circumstance, but you were concerned about this. And it occurs to me, there's capital, there's a whole bunch of different issues at play with these collapses, but one of them is managerial competence. And how do you at the OCC, with regards to the banks you regulate, you didn't regulate any of those banks, or Silicon Valley and Signature, how do you think about managerial competence in a regulatory supervision context?
So to the bank regulator nerds in the room, this will be old hat, but supervisors we spend our time assessing and rating banks on all sorts of dimensions. And you may have heard of CAMELS, right? So CAMELS is basically the shorthand for the things that we rate banks on: capital, asset quality, etc. M in CAMELS is management. And that is one of the key components which examiners spend some time trying to suss out. Is management capable to do what this bank says it's going to do? Can it do it in a safe, sound, and fair way? And so that's really critical. I would add to that, capability is one thing. You've got ability and willingness. Ability is really important. The willingness part, when times are good, complacency can set in. And we've seen this again and again. Just becoming good at something doesn't mean that you're always going to be good at it. In fact, the longer you're good at it, the easier it is to become complacent, to feel like we're great at this, nothing can go wrong. And that's usually when things go wrong. So that's why, as supervisors, we put a lot of attention on not being complacent. A fair amount of healthy paranoia about what things can go wrong is really good. And where that's not there, you see things can go wrong.
So back in February, you held a symposium on bank mergers, and the FDIC has issued an RFI on bank mergers. We've really seen the history of the banking industry, at least for the past 20 years, is really a history of consolidation. And I do wonder if in the current moment, we will see a hastening of consolidation, especially at the smaller level, in light of and in the wake of Silicon Valley Bank. One of our big concerns, of course, is that this component of a public benefit, which is really written into banking law, the component of fairness, as you mentioned in your speech, sort of gets pushed to the bottom of the list. How do you think about public benefit in the context of bank mergers? What ought to be the bar and the standard?
So under the Bank Merger Act, there's a number of factors, statutory factors that we have to follow. And so these are all laid out. And a number of these are, the ones that get the most attention tend to do with competition, financial stability, that's gotten a lot of attention. There is a prong on the convenience and needs of the community. And Jesse, to your point, I think this one often, there's a bit of hand waving that goes along with that. And one thing that I and my colleagues have identified is that we need to update how we evaluate all of this. Are these working for communities? Like, banks don't exist for themselves. They exist to serve communities. And we want to make sure that that is properly taken into account when we assess mergers, when we do our supervisory activities, et cetera. We held a symposium recently, as Jesse had mentioned, and we took each of these prongs and we brought together folks, different perspectives, like how do we improve upon this? And it was really good to just get those different perspectives. And again, we want to make this centered on banks serving their communities.
And one of the things, of course, we have done with a lot of banking institutions, the formation of community benefits plans. And we understand sort of traditionally the regulatory stance on that has been, well, it's a third-party agreement, it's non-governmental. However, these are public statements that banks make in the context of seeking merger approval. They are affirmations made often to the regulators, submitted to the regulators. How do you think about the And yet we've also seen that sort of some of these commitments or plans, particularly those made absent working with a community-based organization, it never seems to really be the kind of follow-through that might be desirable. How do you think about the enforceability of those statements? These are part of the representations made in the process of a merger. Should they be enforceable?
So, linking back to my first point, what we want overall is that banks are really intuiting and understanding what the needs of the community are and doing what they need to do to meet that. That's the bar. That's where, and we want that at all times, not just when there's a merger or there's a potential merger. We want that all of the time. And so I think if you look at the tool set, CRA, that's a big tool, right? And so we're working really to modernize that, raise that bar, and NCRC's been very, very involved in providing ideas on how to do that. In the merger context, there's two things that I think have helped and that were in terms of ensuring that there's that responsiveness. One is a lot of discussion on public meetings. I know NCRC has also been an advocate of more public meetings. I think we have adopted a policy that banks mergers above a certain threshold, $100 billion, we should default to saying there should be a public meeting. Like that is of sufficient enough consequence that we don't think that the arguments for not having a public meeting are that compelling. There should be a public meeting, and those are an excellent venue to say, bring the community together, say, what do you need? Are we being responsive to that? And then with community benefits agreements, it's a great innovation. I think of it as an innovation, as to say, well, now that we've had a meeting, how do you turn that into something that's actionable? We're reviewing that as part of our process, right? Currently, as you pointed out, that's an agreement between community groups and banks. We as a regulator are not party to that. So we have to think really hard about how exactly all of this interacts into our assessment process. It certainly has a lot of informational value there, has a lot of benefits for communities. We're still working through exactly how to put all these pieces together into a formal assessment process.
Well, one of the things that seemed to be a point of consensus at the symposium was sort of a question of whether the current standards for measuring competitiveness
yes.
really adequately assess. And I'm going to wrap in sort of a second question here. When you see in a competitive context, banks continuing to charge overdraft fees that are maybe disproportionate to the actual risk they're taking, or something like overdraft protection, where there's really no cost to the bank, and all they're doing is charging a fee for moving money amongst your accounts because you forgot to do it. How do you think about what some regulators have called junk fees, or fees and practices, products that don't really add value to the consumer in the context of competitive effect? Because one would think in a competitive world, some banks would stop offering those fees and other banks, and compete with other banks. And yet we've seen now a sea change in terms of overdrafts, but it's been very slow to develop.
Yeah, so I totally agree. It's way overdue, right? The overdraft changes are way overdue. It has accelerated over the past year, and I think that's promising. I think us coming out and kind of highlighting where there are those UDAP risks will help even more. Jesse, I think what you're highlighting is we've got a competition issue, we've got consumer protection issues, and we've got UDAP unfairness, deceptive practice issues. You have to work on all three at the same time. I think the traditional approach has been, we're going to have a group over here focusing on competition, and they're kind of an economist, HHI perspective, a group over here that does consumer protection. No. You got to think about all of them together and to figure out where are those, how does it come together to protect consumers, to put communities first. And that's what we're trying to do as we contemplate kind of elevating fairness and putting people first.
Last question. I'd be remiss if I didn't ask about CRA, and we don't have a final rule yet. So I know there are limits to what you can say, Comptroller. But first of all, what is the current timeline for CRA? And then secondarily, we've really pushed for the consideration of race in CRA. Of course, the history of CRA
Yes.
was really about redlining, which was racialized discrimination. And one of the biggest critiques of CRA is, well, it hasn't really been effective in solving for racial economic inequality, the racial wealth divide, because it wasn't designed that way. And yet there are some real constitutional questions and issues, concerns about subjecting CRA to an affirmative action type attack with the courts. What are the ways in which you think the new CRA could and should address issues of racial economic inequality?
So I'll make 3 points. I'm going to reiterate the point you made because I think this is very, very important to recognize the historical roots of CRA are born out of a long period of state-sanctioned redlining. That is, we have to recognize that, and CRA was adopted as part of the civil rights package of bills. So that it has those roots, which are very, very important. Second, we have to meet both the spirit and the letter of the law with regards to CRA. And I think what we're working on now within the 3 agencies who, some folks are here have been working around the clock to get that done. There's been a couple events recently, which you may have heard of, which may impact some timing, but we're moving with all deliberate speed on that package. And that is, it's hard to understate. We see this as a historic opportunity to really raise the bar, strengthen and modernize the CRA, because we recognize this is the racial wealth gap has gotten worse, and that is not an acceptable place for us to be. That's not an acceptable place for the banking system to be. There's recognition of that, and we're going to work towards, with that in mind. It's very important.
Great. Thank you so much, Comptroller Sue. A hearty round of applause.
Thanks for having me.
Thank you.